Well, let's get more on that session, and we're joined now by Chris Weston from IG, Chief Market Strategist from Melbourne. Chris, great to get your views on all of this. It's interesting because alongside all of this too, we've had the PBoC putting more liquidity in system, money to the banks, 500 billion yuan. That also too, helping to lift things like the Aussie dollar.
Absolutely. I mean, I think this was probably the major driver. I mean, I heard you mention in the synopsis there, John Hilsenrath's column where they're suggesting that there's not going to be many tweaks. I think that's naturally consensus now that the Fed are going to continue this sort of lower for longer policy. However, I think they'll probably give reasonable suggestions that perhaps the October meeting they may look to tweak some of their wording. So it might not be an all-out dovish affair that perhaps some people have been positioned for, and hence why we saw the move in the S&P. But what we saw from the PBoC was a fairly quick-fire response, albeit there is no confirmation of this. This came through Sina.com in China. PBoC haven't actually confirmed that they've done this at the moment, but all accounts is that this is a fairly quick-fire response back to the weak data that we saw from the weekend and the 14% fall that we saw yesterday in foreign direct investments as well. So they're going to effectively lend money for its standing facility, $80 billion worth of liquidity to the top 5 banks. Now, the major difference between this and what we've been seeing in Q2, I suppose, was we saw reserve ratio cuts to certain commercial banks. The big 5 banks were never affected by this situation. Now what they're effectively doing is increasing base money, which of course we know is quantitative easing, and lending 100 or half a billion renminbi to these top 5 banks. Now they are expected to lend this money on. They probably won't, and as a result, the money will probably make its way into asset markets, and that's what obviously happens with quantitative easing. So this is a different response from what we've been seeing in Q2, that they're actually using the top 5 banks as their methodology to try and spur growth. Whether or not actually increases lending, I'm sceptical, but markets love the situation. We get an increase in base money. We know it's quantitative easing there, but yeah, there was a 2.5% rally in CME copper overnight, high-grade copper. The Aussie dollar had a 1% move. I mean, if you look at the A50 futures, which are the top 50 Chinese companies where the futures are settled out of Singapore, that nearly rallied, 2% or so, so we're potentially going to have a good day in China today. But yeah, anything that's been seen as a bit of a proxy from China, love the fact that we saw this fire response from the PBoC, albeit it hasn't been confirmed yet.
So with all of that then, the Australian share market, the ASX 200, looking like it could see a bit of a recovery day today, would you think?
I think so, absolutely. If you look at the price action yesterday, it was starting to get a bit more bearish. We were looking very closely at some of these big longer-term trends that are in the market. If you look at the uptrend from the March 2012 lows, that came in at 54.20. People were saying perhaps we could get a break of that. It could look like when we're in correctionary territory, or at least we're eyeing a correction. Everyone was talking about this 200-day moving average at 54.16. I don't really put a huge amount of credence. I know the fund managers like to be buying stocks above that average, but it's trading sideways at the moment and it really doesn't give any major indication. But we're going to pull back above that level. Those trends are not going to be broken today, which is obviously a positive for the bulls. And we're calling the market up 25 points today on the ASX 200, so that's about 0.5%. BHP's ADR will naturally be buoyed, and certainly the cash market will open up in response to those Chinese actions, as I say, which haven't been fully confirmed yet. But certainly energy will do nicely because the Brent prices, WTI prices are higher, and that was one of the best performing sectors on the S&P. So I think, sort of the resource energy space will do quite nicely today.
Just in terms of, I guess, all the event risks out there, Fed, obviously, Scottish referendum as well. What are traders doing?
Well, traders are doing not a lot, to be honest, Bridie, to be honest. I mean, if everyone expects the Bank of England, or sorry, the Scots to vote no, there were 3 polls that came out last night. All of those polls said exactly the same thing, that 52%, if you take out the don't knows, are voting no, i.e. we want Scotland to remain part of the United Kingdom. Yes got 48%. All 3 said the same thing, although there was an ICM poll which actually got the numbers wrong originally, and there was, they had to reverse that pretty quickly, which is, I'm sure, is a bit of an embarrassment. But if you look at the polls at the moment, everyone's saying no is the correct, seems to be the consensus there. and I think Betfair have actually paid out on their calls now. So I think they would say it's a fait accompli. In terms of the Fed, John Hilson-Raff's article seems to have pushed everyone into the idea that the main thing which we're going to be looking out for is going to be their 2017 projections on the Fed funds rate. We expect them to be around 3.5% for where the Fed funds neutral rate is going to be longer term. That could have very big implications on how fund managers price assets based on that Fed funds rate. It obviously has a huge impact on that situation. So look, I think the market seems to have got this idea that Scotland will remain part of the UK. You can see that in short sterling futures. The market's still pricing in 89 basis points for the cash rate in the UK to be around March time. So they don't, there's no stress there. If you look in the currency market, sterling remains bid, or at least it has done over the last 12 hours. The US Treasury market doesn't seem to be doing a lot. So I think people are sitting on their hands, and that does concern me a little bit. I mean, if we do get a change in the Fed's wording from that considerable time, if Scotland does vote yes, then I think we're coming on Friday, and there's going to be absolute carnage on markets. But we don't expect that to see it. That's not our base case at the moment.
All right, Chris, great to get your views. As always, plenty to watch out for. Thank you so much.
Thanks, Bridie.
Chris Weston there.